What are the different types of real estate investments? Hey, I'm Arianne, and if you're new to this channel, we upload weekly videos on money, investing, and real estate to help awesome people like you retire early and achieve financial freedom ASAP. Maybe you're curious about how you can invest in real estate. Or maybe you're already investing but you want to see what other options are available. Or maybe you've always wanted to invest in real estate but you just don't have the time. Then you're in the right place. I'm going to talk about the different types of real estate investments and different ways to get involved, whether it's passive if you don't have a lot of time, or active if you have a lot of time to invest, and what kind of returns you might see from each type or class and your level of involvement. So first of all, we're going to talk about the actual types of investments you might see in real estate. So when people talk about real estate, they usually think about rental property. And what they usually think of is single family rental property. So this is the first type and it's the most popular, right? So it's you buy a single family home and you rent out the single family home. Now within that realm, there's also small multifamily, which is 2 to 4 units. It's a duplex, triplex, or fourplex, and it's kind of the same idea with a single family, except you get to buy 2, 3, or 4 all at once. Now the next one is short-term rentals or vacation rentals. And I live in Florida, so this is really popular here. We actually have one short-term rental near the beach and we get to enjoy it while we also make money on it, so it's awesome. This weekend we actually have friends coming to stay and we're gonna spend some time with them. The other one is large multifamily or buying apartment complexes. And this is one of my favorite ways to invest in real estate, mainly because of the economies of scale and also that it helps us invest with other people who are a lot more experienced than us, and it also helps spread the load and it helps people kind of focus on what they really want to do. So on the totally passive side, we get to invest and kind of just see our money grow while other people do the work. And it's because the pie is bigger. So if you think about like 1 to 4 unit deals, right? It's kind of a small pie. So there's not a lot of room to cut that pie and divide it among other people to partner together. When you think about large multifamily, we might be buying a 100 unit complex. Well, that's a big pie. So even if we cut that pie into different pieces, the piece of pie is still big and we can have a lot of people partner on that deal together. The next one is self-storage. And then we have RV parks and mobile home parks, and some other commercial types like hotels, office buildings, warehouse space, etc. And that's not even an exhaustive list. There's so many ways to get involved in real estate, and what you want to do is, now that you know that there's all of those different ways to invest, then you can do more research and kind of figure out the niche that you want to carve out and you want to focus on. Maybe you like the idea of self-storage because you're like, well, there's no tenant to break the toilet. There's no toilet, right? I know a lot of people who invest in that space and they're happy with it. Or maybe you like vacation rentals because you just love the idea of short-term rentals where you have a place in a vacation area you really like and you get to use it some time of the year and then get to rent it out. Like maybe you build a whole portfolio all like that. So just whatever it is that really interests you, research more about that and that niche and how you can get more involved. Okay, so part 2 is how much time do you have to invest and how can you get involved based on how much time you have. So I separate this into totally passive or semi-passive. So the totally passive way to get involved is you invest with others. Now I know this can be a mindset shift for a lot of people because I actually know a lot of people who don't invest in real estate because they say that it takes more time than the other investment options. Well, it's mainly because they don't know that there's actually passive ways to invest in real estate. And this is by investing with others. So the people who want to invest passively probably have an active business somewhere else, or a job that they love, or a cause that they're more passionate about than actual real estate deals. And they have more money than they have time. So this is a great way to invest if you fit one of those criteria. This is as close to being truly passive as you can. So what you do is you invest with others who are the people who are running the deal, they're the active partners, and you get to sit back and collect returns while others do the work. So now there's pros and cons, and I'm not gonna talk about all the pros and cons of investments because you know that, right? There's risk with any investment, but specifically on the totally passive side, the pros are that you have low time invested, you have good returns, you can put your money to work in a relatively quick time frame, let's say 1 to 4 weeks from when you initially start looking at opportunities. The thing I love about being passive is you're not tied to a location. So one of our main goals is to travel and see our family overseas. My family lives in the Philippines and New Zealand, and so we like to travel a lot to see them, right? And I like not being tied to a location. And with totally passive investing, you also have more opportunities to diversify. Because if you're only investing by yourself and you have to find rentals in your backyard, well, there's just not as many opportunities. Now, the cons of totally passive investing, first of all, is risk, right? And this risk is more that you you do invest with someone else, right? Kind of like when you invest in a mutual fund or stocks, you're not completely in control of that asset and of that business plan. Whereas if you buy your own deal, then you are in complete control. So the other con is it's not investing in real estate passively, the way I talk about here, where you partner with others to buy large deals, isn't necessarily available to the general public. Typically, you have to know and network with the right people who have access to those deals so you can be a partner with them. Also, you have to find good people to work with, right? So you actually have to vet the people you're working with, because a deal is a deal, but if you work with someone who is not a good person, well, there's a good chance that a good deal could turn into a bad deal. And we're going to talk about how you find people to work with, how you find people to invest with, and more importantly, how to vet them later in the video. Okay, so if you're not wanting to invest totally passive all the time, you can also consider being a semi passive or active investor. And this is where you buy and manage your own deals. And this might be someone who wants to be more involved. They want to do the work and find the deal. They love just the act of like talking to a lot of people and putting a deal together. They put together the financing, they manage the renovations and the other business plan items. They also asset manage the property, right? So even if there's a property manager, you have to manage the property manager and manage the business plan. And if there's any fires that the property manager can't solve, then you're the one putting out those fires. So that this is more an active role. And I say semi-passive because usually the beginning year or 2 years is a lot more active, right? Because you gotta find the deal. That alone can take 6 months to 12 months. And then after you buy the deal, which is very stressful, right? Like there's financing and like due diligence and all of that. After that, you still have to stabilize the deal. Now, after stabilization, it can be more passive than it is active. So I call it like semi-passive. So the pros are you have more control. the deal pretty much relies on you. You have to find a good deal. You have to finance the deal right. You have to renovate the deal right. And you have to manage the property manager well. And the cons are also more control, right? Like all that I said there, you have to do, which means you need a lot of time. If you're embarking on the semi passive route, you typically want to dedicate at least 6 to 20 hours a week on these tasks. And the other con is that you're usually tied to a location, right? So if you're buying properties and you're the one who's doing the due diligence, you're the one who's checking on the property every month, then you're kind of stuck where that is, right? You have to be at the property location. Whereas if you were totally passive, really you can invest in anywhere in the country or really anywhere in the world, and you wouldn't necessarily need to have to go there. Another con of the semi passive route is you have less opportunities to diversify. Okay, so now that we talked about those two general ways you can invest in real estate in relation to your time, right? You either have a lot of time and you want to be more in control and find your own deals, or maybe you don't want to spend that much time and you want to spend your time elsewhere. Well, you can invest passively and partner with other people and invest with them. And now that we talked about those and the different classes or types of real estate investments, then you're asking, what returns can I expect? So, on the semi-active or semi-passive or active route, right, which is you buying your own deals, well, really it's completely up to you. You create your own destiny. After all, you're the one buying it, you're the one managing the business plan, and you're the one managing it after you do the renovation. So, it's really up to you of how good of a deal you can buy, but typically people aim to make at least a 10% cash on cash return if they're buying the deal themselves and managing it themselves. But if you're really good at finding good deals, then that could be a lot higher, right? Now, on the totally passive side, this mostly depends on what asset class you're investing in. And if you're lending, then it depends on what you negotiate with the people you work with. So on the totally passive side, there's like two general ways, right? So you can either partner with someone and invest in a deal with them, or you can lend to someone. And I know that kind of sounds similar, but it's slightly different, right? When you partner with someone, you're kind of in the deal with them, right? So whether the deal goes well, your investment might do better. If the deal doesn't do as well, your investment might do worse. If you're lending to them, well, they owe you that money. So if you agree on a percent, let's say you agree on a 6% rate when you loan them the money, then they owe you 6% whether or not their deal does well or not. So we've experienced this in our business. We have a house flipping and wholesaling company, and there have been flips that have broken even and lost money. But because our private lender, we agreed on a certain percentage, we still pay them that percentage. So we lost money on the deal, but they get all their money back and the percentage return, right? So they still got, let's say it was 6%, they still got 6% annualized on their money, even though we lost our money, right? So that's the main difference between lending and partnering with someone. The more potential risk there is in the deal, the higher the rate typically is, right? And the less risky the deal is, the lower the rate. So on the lending scenario, it's usually 6 to 10% what you can make as a private lender. And that 6 to 10% really just varies in terms of the risk of the deal. Now, you could also be a partner in a large deal like a multifamily deal or apartment complex deal. And usually, those average annual returns range from 10% to 20%. And again, it just depends on the asset class, depends on how risky the deal is, how stable the deal is. But that's usually the variation, 10 to 20% annualized returns. And remember, you want to trust the person you're working with. Don't be short-sighted by the large numbers, because again, that's also an indicator of potential risk. So I know I mentioned earlier that we're going to talk about how to vet the people you work with and how to find someone that you want to work with. So first, let's talk about how to vet them. When you invest with someone, the most important thing you want to look at is their character and their integrity, right? So ideally, you're going to invest with someone that you have an idea of who they are, right? You know them or you know someone who knows them. And you want to look at their track record of success, them and their team, right? So maybe you're looking to invest with someone and you see someone who this is their first deal and the deal looks great, but they've never done a deal before. And they're promising you, I don't know, 12% return. And maybe you're looking at someone else who you've known for a few years and you know they've done hundreds and hundreds of transactions and they've returned capital before and they're offering 10%, right? So who do you pick? Like for me, I would pick the one who's offering the lower return, 10%, but I know they have a great track record of success. So I know that this has a better probability of me actually hitting that return. Whereas this person who's new, who hasn't done a deal before, and is promising a higher return, where that promise might not actually happen, right? So look at integrity, their character, and look at the track record of success. And also number 3, you look at the deal. Right? So you're watching this video, you're all about learning and growing, so you probably know a good chunk about whatever asset class you're investing in. So you want to look at the deal too. And make sure that the business plan looks like a reasonable business plan, right? Like maybe the goal is to increase rents to, I don't know, $1,000 a month. And you look at the area and every other apartment complex is renting for $700 a month, right? So how are they gonna rent it for $1,000 when all the competition is renting for $700? That is not a good business plan, and that probably isn't a good deal. Okay, so we talked about how to vet the person you're gonna work with. Next is how do you find them? And the way I like going about this is think about who you know who already invests in real estate and ask them how you can invest in what they're investing in. They're usually gonna give you some options. Like if they're investing in something that has maybe it's a big pie, right? And they have room for you to invest in with them, then they'll probably tell you about that. Or they can point you to someone that can help you, right? Maybe they're mostly passive investors and they're investing with someone passively. They can usually make the introduction to that active person who's putting together the deal so you can invest with them as well. Check out this other video about the truth behind the average rate of returns because as you're investing in different asset classes, you'll see that there's a lot of things on the internet that might not necessarily be what actually happens to your cash. So just check this video out. You probably will learn something. And it could mean a few $1,000,000 more for you over the years. So I'll link to it in the description, and you should also see like an end card here somewhere. And don't forget to please click that subscribe button and that notification bell so you can see all the new videos I post about money and investing so you can retire early and live the life you want. Our quote for the day is, "Believe you can and you're halfway there," from Theodore Roosevelt. All right, guys, you're awesome. Don't forget that you can do anything you set your mind to. I'll see you next time.